The quest for a reliable store of value has anchored investment philosophy for centuries. As economic volatility looms large, the conversation around what constitutes a secure investment is becoming increasingly complex. Gold has long been synonymous with stability, often referred to as the go-to asset in turbulent times. But the rising tide of alternative asset classes, particularly art, necessitates a critical examination of their value propositions in an evolving financial landscape. In the past decade, we've witnessed unprecedented levels of global debt, estimated to be around $300 trillion, coupled with derivative and eurodollar debt that nudges toward 4 quadrillion. Such staggering numbers beckon a reassessment of investments beyond traditional stocks and bonds. As inflation concerns rise and central banks continue their policies of quantitative easing, many are looking towards assets that promise not only preservation of wealth but also appreciation. Art, with its rich history and cultural significance, has emerged as a compelling alternative investment. Historically, artworks have soared in value, sometimes fetching prices that rival some of the most valuable commodities. This was epitomized when a painting by Leonardo da Vinci sold for a record-breaking $450.3 million in 2017 at Christie's, telling a story of art's potential to outperform even gold. However, the landscape is shifting, with artificial intelligence generating art that is capturing imaginations and reshaping our understanding of creativity and value. As the art world grapples with AI's rise, we face critical questions about the preservation of traditional art's value in the marketplace. In this piece, we will conduct a thorough analysis of whether art can maintain its historic label as a store of value amidst the rapidly rising popularity of AI-generated art. We will delve deep into the unique characteristics that define value in art, juxtaposing these elements against the timeless appeal of gold and other tangible assets. Gold has been a cornerstone of wealth and prosperity throughout history, revered by civilizations as a symbol of status, security, and influence. From ancient Egypt, where gold was seen as the skin of the gods, to the Roman Empire that established it as currency, gold's allure has remained undiminished over millennia. In classical settings, gold was often used in barter systems and as currency, underpinning economies and societal structures. It eventually emerged as a standard for monetary systems, with the gold standard serving as a benchmark for national currencies until its formal abandonment in the 20th century. The gold standard, established in the 19th century, linked the value of currency to a specific amount of gold. This system provided a stable monetary environment, facilitating international trade and investment. However, the Great Depression forced countries to abandon this model in favor of flexible monetary policies. The volatility seen since the abandonment of the gold standard illustrates the importance of tangible assets, especially gold, during economic instability. Gold's role as a safe haven becomes particularly evident during times of economic distress. Historical examples abound. During the 2008 financial crisis, the price of gold skyrocketed, ultimately reaching an all-time high of over $1,900 per ounce in 2011. Investors flocked to gold as equities plummeted and uncertainty gripped the markets. Research shows that when stock markets decline, gold historically tends to appreciate. A study examined market performance between 2000 and 2020, concluding that gold delivered an average annual return of approximately 10.6%, significantly outpacing traditional equity markets during downturns. In fact, during the COVID-19 pandemic, gold again demonstrated its safe haven credentials, crossing the $2,000 per ounce threshold as fears of recession mounted globally. Current global economic indicators signal a precarious financial landscape. Central banks are accumulating gold at unprecedented rates, more than 600 tons in 2022 alone. This trend raises critical inquiries about the future of fiat currency and the potential for a new financial reset. Understanding the strategies employed by central banks illuminates the value of gold in the current economy. The People's Bank of China has aggressively expanded its gold reserves, increasingly integrating gold into its monetary policy to mitigate dependency on the US dollar. Such strategic moves by governments underscore the ongoing significance of gold in an increasingly diversified global financial strategy. According to Exeter's pyramid model, assets are categorized based on liquidity and risk. Gold, occupying the apex of this pyramid, is considered Tier 1 alongside cash and US Treasuries. In this model, gold's liquidity, its ease of purchase and sale, compares favorably to other assets. While real estate is generally regarded as a stable long-term investment, it may not offer the same level of immediate liquidity as gold. Conversely, despite significant appreciation potential, stocks can experience volatility that hampers value retention during economic crises. Real-life examples, such as gold's stability against inflation rates soaring above 5% in 2022, while stock markets faced significant declines, reaffirm gold's role in protecting wealth. The valuation of art is an intricate dance between cultural significance, emotional resonance, and market dynamics. Historical masterpieces have fetched staggering sums, ranging from $100 million to $450 million, reshaping what we perceive as art's value. Leonardo da Vinci's Salvator Mundi, attributed to the Renaissance master, was sold for $450.3 million in 2017, marking a watershed moment in the art world. This sale underscores how art's valuation can transcend financial metrics, rooted deeply in provenance. Collectors are often willing to pay exorbitant amounts not just for the visual pleasure of the artwork, but for the larger narrative: who created it, under what conditions, and its journey to market. Art has increasingly found its place among traditional investment portfolios. With low correlation to the stock market, art offers a unique diversification opportunity, allowing investors to hedge against volatility. Statistics support this trend. According to the Knight Frank Art Index, high-value art has experienced a compound annual growth rate of 6% over the last decade. During this time, art has outperformed stocks, bonds, and even gold, revealing its competitive stature as an investment class. The post-war and contemporary art market has exploded, with auction house sales reaching approximately $2.7 billion in 2021. Notably, the emergence of successful artists such as Banksy highlights the growing demand for contemporary art, indicating a bold shift toward relevance and investment potential. The emotional undercurrents of investing in art cannot be overlooked. They play a crucial role in how art is perceived and valued. The stories behind certain pieces elevate their significance, shaping collector motivations. For instance, the storied history of Pablo Picasso's artworks directly correlates to their staggering auction prices. The provenance, where the piece has been, who owned it, adds layers of value. In 2020, Picasso's Femme Assize Prise June Fenêtre sold for $103.4 million, partially attributed to its pedigree of previous ownership by notable collectors. Like other asset classes, the art market is influenced by broader economic conditions. Understanding these dynamics is essential for navigating investment decisions in art. Despite economic downturns, premium sales of art at auctions have often remained robust. For instance, amid the COVID-19 pandemic, Sotheby's reported a 20% increase in online sales during 2020. This adaptability highlights art's potential as a resilient investment. The interplay between art sales and global economic conditions reveals vital trends. Demand for artworks often intensifies during financially strained times, as collectors view them as tangible investments that offer emotional fulfillment in addition to financial returns. AI-generated art has emerged as a groundbreaking innovation in recent years, transforming our understanding of creativity and authorship. Employing algorithms and machine learning, these works can be produced rapidly and often elicit profound emotional responses, blurring the lines of traditional artistic expression. Generative adversarial networks, a subset of AI, have revolutionized how art is created. By training algorithms to learn from thousands of artworks, GANs can generate new pieces that mimic the style of historical masters or innovate entirely new genres. Notably, the portrait Edmond de Bellamy, created by the Paris-based art collective Obvious using GAN technology, made headlines when it was auctioned for $432,500, spotlighting the financial potential embedded in AI-generated art. AI art has found its way into mainstream culture, attracting significant attention from galleries and collectors. Art Basel and the Venice Biennale have featured AI-generated pieces, underscoring their place in contemporary discourse. The exhibition Uncanny Valley showcased AI-generated art alongside traditional works, demonstrating the growing acceptance of these pieces within professional art circles. Featuring works that evoke both human and mechanized creativity, it encouraged dialogue around the boundaries of artistic identity. As AI art emerges, ethical questions surface around authorship and originality. Who should be credited for the creation? The algorithm, the programmer, or the curator of the dataset used to train the AI? In discussions of ownership, unique challenges arise. An artist may train an AI to generate works based on their individual style, launching debates about creative ownership when machines replicate human expressions. This new territory challenges our understanding of the artist as the sole creator. While the popularity of AI art grows, concerns about potential market saturation arise. If machines can create art rapidly, will the value associated with traditional human-made art diminish? As AI-generated art proliferates, predictions indicate that the market may become flooded, potentially leading to decreased prices for AI pieces. Nevertheless, exclusive works or collaborations between AI and established artists may still retain elevated value in the eyes of collectors and investors. Examining traditional and AI art reveals complexity in how we define artistic value. Both provide aesthetic value and emotional engagement, but their paths to valuation diverge significantly. A comparative analysis of typical auction prices illustrates the disparity in value perception. Traditional masterpieces often realize amounts in the millions, while AI-generated art, although commanding attention, currently occupies a different pricing tier, primarily due to questions surrounding authorship and originality. Art serves as a mirror of societal values and cultural shifts. Both traditional and AI art reflect the influences of their respective eras, echoing our collective dreams, questions, and societal dilemmas. Consider how Diego Rivera's murals captured the spirit of the Mexican Revolution, or how modern AI-generated art echoes fears of automation and technology's role in society. Both forms offer insights into their contexts. What comprises investment-grade art can vary. Factors such as historical significance, artist reputation, and condition impact value. Investment-grade artworks frequently carry proven track records of appreciation. The gallery tracks returns on sold works, sometimes yielding multi-million-dollar profits over decades. Blockchain technology offers transformative potential in art ownership, enhancing provenance and authenticity tracing. Platforms like Myco and Artsy are pioneering fractional ownership methodologies, allowing multiple investors to collectively buy shares in high-value artworks. This approach diminishes barriers to entry, elevating accessibility while stimulating market engagement. As we project into the future, the intersection of traditional art and AI-generated work poses questions on the evolution of value perception. Insights from art market experts such as Jason Bailey, founder of Artsy.net and artist advocate, indicate that the viability of both traditional and AI art will persist, but their value criteria may soon diverge. In conclusion, while the essence of gold as a Tier 1 asset at the bottom of Exeter's pyramid remains constant, the evolving dialogue around art illuminates the ever-shifting landscape of value in the marketplace. The relationship between traditional art and emerging AI technology is not a zero-sum game. Rather, it promises a richer, more diverse cultural capital resistant to economic upheaval. As we navigate this landscape, the essence of what we deem valuable will undoubtedly continue to evolve.